Hello, everyone. This is Tim Davis here. Welcome to my channel. This is something new that I'll be doing from week to week. And you can catch these updates or these market reviews on a weekly basis on my YouTube channel. And I will also provide a link from my YouTube channel onto my Twitter account and my Facebook account. That way, you can always find your way back to this recording and update. So let me do some housekeeping things here, and I'm going to go ahead and get started. Okay. All right. So again, folks, Tim Davis here, and for those of you guys who know me personally, you know I've been following and trying to understand and trade the market for many years now, and things are really starting to take form. What I've been expecting to get out of my personal training and following over the years. So now I want to share it with the world personally, on a personal level, not with any other big companies attached, but just on a personal level. I want to be able to share stuff with my family and friends on a weekly basis to hopefully get you guys engaged and get you guys paying attention to what's going on within the markets, and to help you to learn about technical analysis, which is what I use in order to track the market. I look at technical analysis using software where I can pay attention to what the charts are showing me on a longer term basis. Once you understand and learn how to read and understand charts, that can pretty much give you an overall sentiment of what the market is doing. So I don't really pay attention to fundamentals because of the way I trade and I invest. All that stuff, you know what I'm saying, is actually built into overall sentiment of the market. And you can see those sentiments by paying attention to what the charts are showing you. So as you tune in week to week, you'll probably start to learn and get some of the things that I do in order to follow and track the markets. And some of the things that I show you on my chart, you'll start to understand them slowly but surely. And then if you want some personal insights, you can always reach out to me. And I'll be willing, you know what I'm saying, to set up some personal coaching if that's what you desire. If it's something ongoing, then it may be a small fee involved, but we can discuss that at a later date. All right. So with that said, some things that I like to do is pay attention to certain articles. So I pay attention to certain news articles. I pay attention to economic news and certain tools I like to use. So what you see on my screen right now is something that I found out about or learned from another channel, another Twitter page, someone who I follow who tracks the market as well. And what you're looking at is the Wall Street Journal, and this page tracks the markets. And what it does on a day-to-day basis is that it lets you, give you the ability to see how many new highs and new lows are being created in the market on a day in and day out basis. And this is important to understand market breadth. Market breadth of the market pretty much lets you know how the market is skewed. Is it skewed towards, a bullish atmosphere, or is it skewed towards a bearish atmosphere? So in a strong bullish market, you want to see, more and more stocks participating in creating new highs. That helps, helps prop the market up and points the market into a bullish fashion. But when you start to see more and more stocks creating new lows, that's a sign that the overall market is starting to become weak. And if you see it on a regular basis, that means the market could be at a detrimental or dire state, or it could be just being a reversal to the downside. So with that said, right now what you see, so this tracks, oops, let me get rid of this. Very first line here, you see where it says new 52-week highs and lows. Then you got two tabs. One says New York Stock Exchange, one says the Nasdaq. So the first tab I'm looking at is the new highs and lows for the New York Stock Exchange in general. So this very first one you see where it says new 52-week highs, and it tells you the amount of new 52-week highs from the last trading day. And this was Friday. This was posted on Friday, January 21st, 2022. And look what we see. Only 8 new 52-week highs. Then I'm gonna scroll down. This could be a shocker. Look at the lows. 526 new lows on today. So at the end of this week, 526 new lows showing on this Friday versus just 8 new highs. So that's pretty much showing the breadth of the market is skewed towards the downside, folks. Okay, so that's another tool to give you some insight of what's happening beneath the surface. This breadth of this market is really skewed towards the downside. Now let's click this little tab here and see what the Nasdaq is showing us. So the Nasdaq is another index within the New York Stock Exchange and within the U.S. market. So Nasdaq, which is heavily skewed towards big tech stocks, a lot of tech stocks. So it's heavily skewed, but it doesn't just Nasdaq doesn't just consist of tech stocks, but that's where most tech stocks reside, is underneath the Nasdaq. So here it shows 52-week highs, 22 52-week highs that was shown on Friday. And now let's see how many lows. Look at that. New 52-week lows, 1,322. So do you think this market is really skewed more towards the downside now by looking at this? Yes. 1,322 new lows, new 52-week lows, which means the overall market right now is trending downward. Now let's take a look at some charts here. Okay. So here is the Nasdaq. I'm sorry. Here is the here's a tool that tracks the S&P 500 stocks that are trading above their 200-day moving average. I want to start off with this one because this is another tool that can help you understand and track overall breadth of the market. So on my screen here, you'll see I got 6 different frames, and I like to look at different frames on my screen because I like to look at different throughout the week when I'm trading. When I'm looking for something else to get into, I like to have certain things on my screen to keep me up to breast what's happening at that particular time. So I'm going to blow up here one of these screens and take a deeper dive into this tool that I'm talking about. So again, this tool at the top of my screen, you can see where it says percentage of S&P 500 companies trading above their 200-day simple moving average. So this lets you know, the percentage of S&P 500 companies that are trading above their 50-day, their 200-day simple moving averages. Now, for those of you guys who don't know much about moving averages, okay, you'll learn as you continue to follow me on a week-to-week basis. 2 of the major moving averages that I pay close attention to is 50-day moving average, and I have this on my chart depicted by this blue line, and a 200-day moving average. If you start paying attention to economic news on a regular basis, CNBC has a good channel on there. You'll hear them talk about the 52-day moving average. You'll hear them talk about the 200-day moving average. Those are the 2 major ones. And when price action, trades above it or below it, it signifies, overall direction of the market. So I popped this 52-week, 50-day moving average on almost anything that I take a look at. And this is a percentage. So this is not price action movement, but this is a percentage tool that tracks the tools, the S&P 500 companies trading above their 200-day moving average. And just for just a short explanation, anytime price action is trading above this 50-day moving average, normally it's considered to be favorable for the bulls. Let's put it that way. Favorable for the bulls, as price action on percentage could be heading higher. When you start to drop below that, it's more favorable for the bears. So that said, the highest that this percentage was over the past year was 97%. I'm gonna go back in time and show you guys just to paint a picture of what we could be looking at overall. I'm gonna go back all the way to some times that you guys are probably familiar with. 2009, just 2008, 2007 to 2008. Right here was 2007. And look what happened between 2007 and 2009. You see the percentages were getting lower and lower and lower. I highlighted the tops of these percentages because I wanted to make sure that everybody understands where we are trading at right now. So every time we have hit this area, which is between 90 to 97%, there was a pullback in the overall market. So from 2007 to 2009, we know what happened back then. It was a housing crisis. Look, we were right around at 90 to 97% of S&P 500 companies trading above the 200-day moving average. Then we got a pullback, which lasted for a couple of years. Then again, between 2009 and 2010, the market did rally from 2009 to 2010, but hit this area, traded sideways for a bit, and then pulled back again. But we did not go as low as we did in 2009. Okay. So when you have this indicator hovering around these highs, that's a good bullish sign for the market. But when it starts to dwindle, it tells you that there's less and less stocks trading above their 200-day moving average. This right here, if you see this little 0.1, that means there was that's less than a tenth of the stocks are trading above the 200-day moving average. That's a big bearish signal. So as this continues to go down and we start to lose momentum, that's telling you that the market is looking for a reversal to the downside. And as it rips up, turns back up, that means that the market is starting to become a little bit more bullish. So if you was a technical trader and you were able to see this consolidation pattern here at the bottom back in 2009, as as the percentages start to slow down, the selling started to slow down, we started to trade sideways. That could have been a good indication to you that there's a bottoming process that could have been taking place, which would have gave you an insight to say, okay, maybe I want to switch my bearish stance to a bullish stance and start buying the market. So those folks who understood this back then in 2009, they made out pretty well because the market made a quick reversal back to the upside. So when we get around these highs, around this 97 percentile level, 90 to 97, pay close attention and see if we're consolidating, which means we're just back and forth because eventually there's going to be a reversal. And it happens almost every time. So now, fast forward to now. Back last year in 2021, I highlighted this. I said, okay, folks, pay attention. We are coming to a possible topping pattern. This tool started to trade sideways between 2020 and 2021. And we all know what happened in 2020 when we had the COVID plunge. We dropped all the way down to we were trading up around here where we were about close to 90% of the S&P 500 companies trading above their 200. Then we dropped all the way down here to about less than a tenth of a percent. So big move down. Then we rallied right back up, back towards this area, even went a little bit higher. So that was a big sign for me to start paying attention to possible weakness in the market. So again, we stayed around this level between 90 to 97 for almost a course of a year. Then lo and behold, in April of 2021, we started to see some weakness within the market underneath the surface. A lot of people didn't see this because they were only paying attention to the day-to-day action of some of these big mega companies that were still in full bull mode and were rallying, but beneath the surface, the breadth of the market was deteriorating. I saw that, started looking at, where we could be going in the future, and started to readjust my positions. Now, there's some other technical tools in here that could also show you that the overall market is starting to switch partners. Right down here below where you see this light blue line and these light blue bars, these dark blue bars, that gives you some type of that gives you some type of signal of the overall sentiment of the market. So as these light blue bars are getting higher, that's telling you that the overall sentiment of the market is still positive. And as they start to get dark blue, that means overall sentiment is starting to lose momentum, or the market starting to lose momentum to the downside. Next little indicator below that, you see this red and this green line. This is called the full stochastics, which pretty much tracks any type of movement in the market that's showing you a possible change in direction. So as these lines are going up towards the top of this line here, that is a signal that the overall market is trading higher. But as we get above this blue line here, I start to look for changes when we start to decline, start to reverse, because that also can give you advance warning that this overall positive move is starting to turn into a negative move. We started to get that turn downward back in June or July of 2021. Next indicator below us, the Williams percentage, also gives you some warning. So when these oscillators start to dip out of this area up here, which is called the overbought territory, you start to dip out of that area and start to show some divergence, which means this action is diverging from what you see in the candlesticks. Started to go lower. That's telling me that the overall market is starting to hinge or hedge lower. And the bottom is RSI. And I'm gonna get a little bit more, talk a little bit more about RSI when we start looking at some individual indices. So again, we started to see a lot of weakness back in earlier last March 2020, 2021. I'm sorry. All right. So now we're here. So we were back in April around 2021. We were trading. The market was straight bullish. 97, almost 100% of the stocks were above that 200-day moving average. Look where we closed on this past Friday, which was 1/21, 2022. Right down here, and you can see where I'm circling my cursor around, 50%. So we went from a 97% of stocks trading above that 50-day moving average to just 50%. That is a sign that's showing me that the market breadth is losing its momentum, and we are starting to trend downward overall. So that breadth of the market is getting much weaker. So we see this in the technical analysis, and I also showed it to you guys right here, looking at easier way to look at it and determine the breadth of the market by looking at this tool, which I do pin in my on my Twitter page, the Wall Street Journal Markets Outlook section, and you can see on a regular basis the new 52-week highs and then the new 52-week lows. So that's another way to look at it, and you can match it up with what the charts are showing you. It gives you more confidence to trade the market a certain way. All right, now let's go straight to the individual indices. Now we're gonna first go straight to the S&P 500. So here's S&P 500. Now, told you guys that these the two major moving averages that I pay close attention to is the 50-day and the 200-day, and you can monitor them on multiple time frames. Each time frame, gives you a different outlook. Now, because I'm a longer-term trader, I pay attention to the weekly and the monthly, as well as the daily, to see where we could be in store for some type of reversal in the near term, to determine how I want to adjust. How I want to play the market as the market continues to do its thing. Now, since I showed you guys a breadth, we know that the overall sentiment of the market is starting to turn negative. Now, in order to position yourself at a good spot in the market, you want to also start to look at something as as simple as paying attention to possible short-term and longer-term reversal points in the market. So even though the market is showing some negative some negativity within the market, there's always a chance where you can have some quick reversals back to the upside that can give you an opportunity to jump back in the market and sell the rally. So as the market sells off and we get these strong bounces, if price action is trading below major moving averages, then you may want to wait to get a bounce. And then when we hit a ceiling or hit a level of resistance, that's when you want to consider trading the market back to the downside. So here with this S&P 500 outlook, you see that the S&P 500 got as high as 48.18. That was, we marked that level back around the beginning of January, and since then you see the candlesticks are starting to trade lower. Okay, now again, this blue line here, that's my 50-day moving average, and now you see another one in play, which is what I like to pay attention to, which is this red line. That's my 200-day. It's my 200-day moving average, and see where price has done. Price came all the way down to this 200-day, and that's where we're resting now. So with that said, on next week, when the market's open, I would not be surprised to see some kind of bounce. But we could start out trading just a little bit lower and then start to get a bounce rally. Now, not sure how long that will last, because once price starts to drop below this 50-day, that's considered bearish, unless we rally back above this 50 days and continue on. It has to do more than just rally above it. It has to show a strong rally and continue to rally. Now, what I think is happening here, this yellow line, just anybody may be asking, this is a 20-day moving average. I use that to help give me some more insight of the near term, and also helps gives you early warning signs of what the market could be doing. Now, when these moving averages start to cross below each other, that's also another bearish signal. So ultimately, what we could see here is we could see a little bit more move to the downside, then a quick snapback rally, possibly, in probably all the major moving averages. And right here, what I'm expecting is that this blue line will continue to start to trend downward. Even if we get a rally, what I'm looking to happen is, if the market starts to rally, this blue line is going to act as a ceiling, as a level of resistance, okay, which is probably going to fake a lot of bulls out. So we'll probably rally up, hit this blue line, and come right back down and eventually break this red line. So that's the importance of understanding these moving averages and how they operate. They can act as a level of support, as a floor, and they can act as a level of resistance, as a ceiling, okay? So don't get caught up in these big short-term moves, because when price action falls below these major moving averages, those major moving averages, unless the price really rallies and break out above those levels, they're going to act as a level of resistance and run into that ceiling and pour right back down. So that's what I expect to happen. And this is a daily chart we're looking at. So with price action testing this 200-day, I would like to glance at the weekly and the monthly to get a better look at the bigger picture and see where we could be heading longer term. So what I have here, this is a weekly chart, and as you can see, we just broke below this 20-period moving average, and we're heading towards this blue line, which is a 50-day moving average on the weekly chart. So when I said we could possibly see the market pull back just a little bit more next week, we could see a pullback just a little bit more towards this 50-day moving average on the weekly chart, and then get a small bounce. So that also will act as a level of support. Now, looking at the monthly chart, this is what led me to believe that we could definitely be seeing a bigger move down in the overall market, and maybe possibly even a crash in the market. So you heard that first here from me. And what I like to point out is that I got some other lines on here. I'm not going to get into the other lines I got on here until probably next week. Spoon feed everybody who's just joining me for the first time. But This tool where you see 0% all the way down to 100%, that's called a Fibonacci retracement tool, and I will explain that probably on next week. I can dig too much into it right now, but this tool, this action that you see here, from here to here, was when we had that COVID plunge back in 2020. Now, and up here where you see 4018 is the highest point we got to during this move back up. We got to see this high up here in January of this year. Now, it looks like to me, this is where the market stops. So what I pretty much did is I drew this Fibonacci tool to try to, this is a retracement tool, to see where price action could be headed next. Also, what I'd like to point out is that this blue line again, this light blue line, this is my 50-day moving average. Now we're looking at a monthly chart. And what I'm explaining to you guys is something that's very simple, is that the 50-day moving average and the 200-day moving average, they normally act as magnets. So price action does not like to be so far from the 50-day moving average or the 200-day moving average. So when we get this big distance here, and we start to see a reversal, the more than likely, my brain is telling me that we could see a further pullback until at least on this monthly chart, that price action gets down to that, meet that 50-day moving average. That is a big move to the downside. Some other things that have shown me that that's a possibility is by looking at the wins percentage tool. You see how it's dipping out of this overbought territory and starting to point downward. That's a bearish signal. The full stochastics has the oscillator starting to point downward. That's also a bearish signal. And also the RSI, which is the relative strength indicator, it is dipping downward too. So all of those indicators are starting to show some bearish activity on the longer term monthly chart. So you know, we see it in the longer term monthly charts. That's a big sign that there could be longer term pain ahead. All right. Now let's go straight to the Dow Jones. Dow Jones monthly chart looks the same. You see these dark blue lines, dark blue bars, and the TTM squeeze starting to form. That's telling us that there's some weakness coming into our market. These oscillators and these other indicators, my wins percentage, my full stochastics, and RSI starting to turn downward. That's also a bearish signal, and looks like we ran into a ceiling up here around this 36,000, a little bit over 36,000 level. That's also indication that the market is possibly at its peak. Weekly chart of the Dow, you can really see this movement here as we hit towards these highs here, almost here, and just a big reversal. It's like we're trying to touch this 50-day moving average, but this is a big red candle. So that means the momentum to the downside is really picking up on this weekly chart. So you could see a stop here, a short-term rally, and then go right back down. The momentum to the downside is just really picking up steam. So any rallies in this market will probably be sold. So don't get caught holding that bag. Here is the daily chart of the Dow Jones. We are already breaching below this 200-day moving average. I told you guys, if we break that in a significant way, it will then become a level of resistance. So we will get pull back below that level. And then if we get a rally, we'll probably hit that and target and come right back down. Now, in the near term, we are near term oversold. RSI, anytime this RSI at the bottom gets below 30 level, that is an oversold level. Doesn't mean that we can't go much further, but it's telling us that we're getting close to an area where we could see a short-term bounce in the market. That's the Dow Jones. Now let's take a look at the Nasdaq. Now, Nasdaq, a little different story because Nasdaq, it is already traded below its 50-day moving average and below its 200-day moving average. So it is definitely in big time reversal mode. It is definitely deeply oversold. RSI is well below 30. So we could definitely see a bounce here, but it could be just a muted bounce. And this 200-day will probably act as a level of resistance. So we can see a rally up to that level and then come right, snapping right back down, folks. And this is a daily chart. Looking at the weekly chart on the Nasdaq, hasn't reached its 200-day, but it's breaching in a big way below its 50-day. So again, we could see a rally in the short term next week, but then come right back down and with this weekly chart starting to really break down. So we could come right back down. Any rallies will probably be sold. So just be mindful and careful of that. Here's a monthly chart. Again, you see 3 red candles in a row, which means the past 3 months, the market has been giving us some signals that we're ready to head downward. And look how far the 50-day moving average is from current price action. We could see it move right back down to this level sometime through in 2022. So I think the overall market is definitely showing some weakness at the beginning of this year. So between now and June, we could be in for some rough seas in the overall market. One more we take a look at, that's the Russell 2000, which is a small caps index. This one I've been tracking all year in 2021, which has been giving us an advance warning. When price action pretty much made it up around these, you see these short-term candles. This is a range that we traded in almost all year between these little small candles. And then the big red candle started to form this year in January, and we're starting to really roll over to the downside, big way. And on the monthly chart on the Russell, we're very close to its 50-day moving average. Not there yet, but I still think we will travel down to that 50-day eventually on the monthly chart before we see any type of, meaningful bounce. But again, it'll probably be sold. The rally will probably be sold if we hit that on the monthly chart. So go to a weekly chart. See that again, the Russell is dipping below its 50-day moving average. Look at that. It's almost like a perfect resistance where we traded up to that level and push price action. I mean, price action got pushed right back down after it hit that 50-day. And looking at a daily chart, we are trading below. And then this is what I like to show you guys, that when this happens, this is a clear signal that you got to pay attention to. Now we have this blue line, which is the 50-day, this red line, which is the 200-day. When that blue line, the 50-day crosses below the 200-day, in a trading world, it's called a death cross. That means this market is doomed for much lower prices. So even on a daily chart, we're starting to see some oversoldness. So I do expect to see some type of move up, a rally up. But as we rally up, if the moving averages don't turn up, that means the rally up is going to be short-lived. So if price action starts to go up, but the moving averages to continue to go down, that's not a good sign for the bulls. So that means it's going to be a trap for those who are trying to trade this longer term bullish. We'll probably have price action run up to a certain level, maybe even back up to 2100, 2105, 2106. Then it'll run into these moving averages, which will probably be turning downward, and then it'll get rejected and come right back down. So that's all the major moving averages, and I wanted to show you guys that to give you guys insight of what to pay attention to and how to track this market. One other tool that gives us some insight, which is the Volatility Index, which is called the VIX. Now, the VIX is showing the opposite of the S&P. And the VIX is like a tool that tracks volatility. And it's also a tool, not only does it track volatility, but it's geared more towards the S&P 500, which is the one of the major indexes that tracks overall movement of the overall market. So if you look at this tool, the VIX is showing a nice uptrend, unlike our overall market. Now, if I break it down and look at a longer term weekly chart, what I pointed out here, and I'm going to show a monthly chart on this, I'm going to show you guys something else. It's how price action is trading above its 50-day and its 200-day, and looks like it wants to go higher. Now, there's some levels here I marked where we can see some type of reversal. I still think the VIX could go up a little bit more, maybe next week, maybe even to about between 30 to 32 before we see some type of pullback. But just like on the other markets that I showed you, the Nasdaq, S&P, and the Russell, as these moving averages as price action on here is going up, you'll see the moving averages start to go up. So any pullback we get here will probably hit the moving averages on the way down, and that will act as an area of support. So that will hold price at that level, and then we'll probably see another move up. So when the VIX, this volatility index, increases, that's telling us that the overall market is starting to decrease in value. And one more thing I'll point out is a monthly chart, and this tells the story of the VIX. So here we see the opposite of the on the TTM squeeze. We had these red bars that were showing on the TTM squeeze on this monthly chart, and now we're starting to see some light yellow bars that are getting shorter and shorter and shorter. That's telling us that the overall momentum of the VIX is picking up steam to the upside on a monthly chart. So we see it on a monthly chart. That's something to pay close attention to, which means we could be in for a longer term up move in the VIX, which means that's just the opposite for our overall markets. Look at the full stochastics and the wins percentage as they are starting to go higher. Full stochastics was the full stochastics was in oversold territory below this blue line. It's starting to hinge higher, and RSI is starting to hinge up as well. And I want to point this out, is that this monthly chart shows that the VIX, see all this volume here. So for these candles here has been showing some big moves over the past several months, and they were getting bigger and bigger and bigger, which is showing us that this overall movement was heading higher. See that? Overall movement was heading higher. So longer term, we see that the monthly charts were showing us that the overall movement in the VIX was actually heading higher over the past several months. Okay, all right, folks, that's my review for this week. Again, I will try to update you guys on a weekly basis just to give you guys some more insight of what's happening within the market. Again, the two major tools that I want you guys to pay attention to is this S&P 500 tool that tracks the percentage of stocks trading above the 200 moving average. The VIX also, which is down here at the bottom of my chart. And I'm going to show you guys this tool, which is a great tool I just started using. Found this on another trader's page. This is great to use. So if you guys follow me on Twitter, here's my Twitter handle. Here's my Twitter handle. I pinned this Wall Street Markets paper or tool at the top of my page, and you can come here, click on this, and you can look at it every day while the market's running. At the end of the day, it'll tell you the new highs and new lows for that particular day. All right, so this is my Twitter page. Again, God's Child Tim is my handle. So that's how you can find me there. And then also you can find me on YouTube. Here is my YouTube. Here's my YouTube channel. Very simple for now. And I will start to post many more videos here on my YouTube channel. You can find this here, just under Tim Davis. And here is the link here. I am going to post this link on my Facebook page and my Twitter page as well. And I'll also, once this video has recorded, I'll post this video here and on my Facebook and on my Twitter. That way you can also get to my YouTube channel and you can befriend me. And here's my Facebook. So here's my Facebook page. Okay, so you have always to start to stay in tune with what I'm going to share with you guys on a weekly basis. All right. Just Tim Davis, and my handle is right here. Tim D 88. So what I am going to do for you guys just real quick, highlight that. And however you find me, if you go to Twitter, you'll be able to find my Facebook page. That's my Facebook. And so I'll tweet that one for you guys. And my YouTube, let's do that one too. So when this will work. All right, so that should help you guys get to me. And have any problems locating my any of my social media, just reach out to me to through whichever social media means that you have access to. All right, folks, I know this video is pretty long, but I wanted to make it pretty long in the beginning because this is something new that I'll be doing on a weekly basis, just sharing some insightful information for you guys and the way you guys can keep a track of what's going on with the market and also keep a track of my journey as I continue to navigate and learn more about this market. All right, folks, enjoy the rest of your weekend and the rest of your day.